Okay, so this is take 4, 5, whatever, of Accounting Information Systems lecture. So tonight we're going to be talking about the accounting information systems, which what that's talking about is how we actually get all of the accounting done for normal accounting. What we've all been doing so far is all just putting everything through the general ledger. Well, that's not truly how it always works. So, the fundamental part of system principles is the accounting information system collects and processes data from transactions and events, organizes them in useful reports, and communicates results to decision makers. We've been talking about that this whole quarter. So we know that there's control, we know that there has to be relevance, compatibility, flexibility, cost-benefit principle. Those are all the system principles that allow us to collect all the data, input it into a system of some sort, and then get reports out that will communicate to the decision makers. So, components of an accounting system. You're going to start with your source documents. Those would be sales invoices or purchase orders or bills. Anything like that. That would be your source document. Checks is also another one. So increasingly, source documents are electronic files created in a paperless system. So paperless files would be electronic funds transfers or credit cards or things like that that you don't actually see the paper. The next thing is your input devices, and that can be keyboards, scanners, modems, barcode readers. That's the type of things that you're going to process this stuff with. Also, it can be computers. The next item is information processors, so that's hardware, software, professional judgment. How do you get from your input devices into your computer system that data so that your source documents flow through? Okay, so that's what that is talking about. So we need to find a way to get from our source documents to our input devices and then into our computer system. Then we talk about information storage. That can be on a CD or a DVD, while those aren't as reliable because they can get lost, stolen, thrown away, broken, whatever. Hard drives, those are on all computers. You contain a hard drive. Again, you need to have a backup of some sort of that hard drive, because if you just have a hard drive and that's all, then you have a risk of, if that hard drive fails, of not being able to retrieve your data. The next item is a tape. There isn't very many tape backups anymore. What that's talking about is actually a physical, like a cassette deck or a cassette system that you used to play music on. That's the kind of thing that they actually put all your backup on way back when. And the last thing is paper documents. We're not in a complete paperless society yet. I know we're trying to get there, but so far we're not there. So there is still paper documents. And we have to make sure that all that stuff is stored somehow. So then that's how the cloud storage comes into play. You can have redundant backups or other systems. I know that my iPad is backed up on the cloud. The last thing is output devices, printer, monitor, projectors, web communications. Those are where how you're going to get your reports out, how you're going to be able to see them, how you're going to be able to work with them, how you're going to get them to the people that need them. Special journals in accounting. There are 5 main journals in accounting. All we have been working with so far is the general journal. Now, the sales journal is for recording credit sales, just credit sales. And in the sales journal, you're going to list the date, the invoice number, the customer name, the credit terms, what they bought, and how much the total is. Okay, so you're going to want to keep track of all of that information so that you can record it in a form that you can track. And that's what we're going to talk about a little bit later. It's subsidiary ledger. So, sales journal. The next one, next type of journal is the cash receipts journal. This is recording for cash receipts, which would be receipts on your accounts receivable, all of your cash sales, and any other kind of cash that comes into your company. So all cash receipts come into just this one spot. Then you have a purchases journal, and what purchases journal are used for is to keep track of ordering your parts. So a lot of this is like manufacturing. So if you get a job in a manufacturing company, you need the set list of parts. So you need to order those parts. You can have it when you start your job. So when you do that, you're going to have a list of other things. You're going to give it to your purchase department. They're going to go out and purchase all those items for you. So when they get that purchase ready and make the order, it can go through, and it's going to be on credit because you're going to call and get it. That'll go into a purchases journal, and there you're going to again have the date, the purchase order number, who you're getting it from, the terms, and the amount. Okay. The next one is the cash disbursements journal. This is a check register. So this is going to list all your checks and your EFTs and your auto payments. All that kind of stuff is going to go here. So it's going to have your check number, the dates, the amounts, who you paid. So that's how you're going to make your payments for your accounts payable. The last thing is that the last journal is your general journal, and we have been using that all quarter to record all of our transactions. And now you know where those other transactions really should go: sales journal, cash receipts journal, purchases journal, and cash disbursements journal. The only thing that really gets recorded in the general journal are your adjusting entries, your closing entries, your purchase returns and allowances, and your sales returns and allowances. Those are the types of things that don't fit in those other categories. So we have to put them into the general journal for that. So now we're going to talk a little bit about subsidiary ledgers. There's really two main subsidiary ledgers. There can be more. The two main ones are the accounts receivable ledger, and that is a listing of all the amounts that are due to customer or due from customers by customer. So all of your entries that you made in the sales journal, because that's all credit sales, are all going to go into a accounts receivable ledger, a subsidiary ledger for accounts receivable, and in an account called an accounts receivable control account. It's going to go in both places. Now, if you're in an automated system, this will happen automatically. If you're not, then you have to make sure you post them twice. Once in the control account in your general ledger, and the second time in the accounts receivable ledger. That way you can track how much each customer owes and when it's due. The other main type of subsidiary ledger is the accounts payable ledger. Again, you're going to have a control account, so every time you make a purchase from your purchase journal, it's going to go through the accounts payable ledger, and it's going to list by creditor how much you owe each of those creditors and when they're due. So that way you know to make sure you get the discounts when they come through or when they're due, and you can make sure that it ties to your accounts payable ledger. So make sure, again, every time you make a posting to the accounts payable control account, you have to make an entry to the accounts payable ledger. That's not the only thing that, whenever you make a payment, again, whenever you make a payment or you receive a payment, so if it's accounts receivable, if you receive a payment in the cash receipts journal, that's also going to come through the control account and the subsidiary ledger. Same thing with accounts payable in the cash disbursements journal. Whenever you make a payment for something that's in accounts payable, you're going to have it in both places. So subsidiary ledgers are a listing of individual accounts with common characteristics. The other type of subsidiary ledger could be a payroll ledger. There can be many other types as well, but those are the three that I can think of right off the top of my head. Okay, the accounts receivable ledger used for preparing financial statement is in the general ledger. You're going to have your control account. Control account is just the total. It is just literally the total that's owed to you. You don't know who owes it or anything. So what the accounts subsidiary ledger does is it's used to prepare the bill sent to the customers. So like when you get your monthly bill, or if you send out somebody a monthly bill, you'll know how much is going to be on it because of the subsidiary ledger. There's one account for each customer. The control account balance equals the sum of all of the subsidiary account balances. After all the items are posted, the balance in the accounts receivable control account is equal to the sum of the balances in the accounts receivable subsidiary ledger. So here is an example of the sales journal. So you can see there's a date, the amount debited, the invoice number, that this is a accounts receivable. See where it says accounts receivable debit, sales credit? That's your two-sided entry. And the bottom is listing where it's underneath the total. The double underline means the total. You got a 106 and you got a 413. Those are account numbers. And same thing, whenever you have a sale, remember, you're going to have a cost related to it. And so then that, again, is a debit to the cost of goods sold and a credit to the inventory. So again, you're going to have two account numbers listed at the total, at the bottom. However, in the subsidiary ledger, the accounts subsidiary ledger, each one of those items, there's 7 items, are going to be listed in the subsidiary ledger for each of those individual people. Daisy, stop. Calm down. So on February 2nd, Jason Henry, if you go to Jason Henry's subsidiary ledger, you're going to see that he's got a posting from the sales journal, and it's page 3. And I don't think you can actually see that it's page 3. How's that? But then you miss. Okay, so it's page 3. And then, so there's the reference, and then you show that it's a debit of $450, and then again the balance. Same thing with Albert Company. On February 7th, you can see that it's referencing the $500. If you notice over in your subsidiary ledger, there isn't the individual detail. It's just listing the month's totals, and that's it. So it's just a total. That's it. Now, in QuickBooks and some of those kind of software, they'll list every sale. But if you're using actual sales journals and subsidiary ledgers, then, as you can see, you would have you would only put in the totals. So that way you can go and reference it back. Proving the ledgers. The schedule of accounts receivable lists each customer